Hello and welcome to Trade Finance Talks. I'm Mark Abrams, a Director of Trade Finance Global. Welcome back to the second of TFG and Standard Chartered's 5-episode podcast series, The Future of Trade. This year, discussions around trade digitalisation have changed in nature. They've moved from simply reiterating the benefits which digitalisation can bring. By now, we know of the efficiency and cost savings. I'm joined today by Sam Mathew, Managing Director and Global Head of Documentary Trade at Standard Chartered, to discuss the future of trade digitalisation. How are corporates looking at emerging technologies to build resilience? How can they grow a strong digital foundation to build off? And can a large-scale digital transformation ever actually be achieved? Sam, welcome. Please could you tell me a little bit more about your role at Standard Chartered?
Thank you, Mark. Thanks for having me and good to be here. My name is Sam Mathew. I run documentary trade at Standard Chartered Bank, been with the bank for 20 over years. And in addition to my role at the bank, I also sit various industry bodies like the International Chamber of Commerce Banking Commission as one of the vice chairs, and also with BAFTA as one of the Asia Council members. Thank you for having me.
Thank you for coming on. And let's start by understanding, actually, what do we mean by trade digitalisation?
That's a good question, Mark. And people use digitization, digitalization of trade and trade finance quite interchangeably. So if you take a step back and look at total global trade, 85% of that happens on open account basis, which means there's no bank in the flow. About 15% happens with the bank in the primary flow, which is the documentary trade business that, for example, I run at Standard Chartered. And when you talk about digitization or digitalization, it's about across that entire bucket of 85 plus 15, how do you get the underlying trade digitized, i.e. we do away with the paper, such that the contract between the buyer and the seller, the actual shipping process and shipment of goods, the evidencing of the same, the risk mitigation and the final settlement of the trade, how can all of that happen without paper being involved in the process? So that's the North Star, that's the nirvana. The challenge today is that we are focused too much on the 15%, which is where the bank is in the primary flow. But the real challenge is how do we digitize the actual trade between the buyer and the seller? And a large part of that problem, which we'll discuss as we go into this podcast, is about getting a key document that is a title document digitized and being able to move seamlessly between all the parties involved in the trade.
And just on the point of your North Star, where we're all moving towards, in a perfect world, digital trade, where are we in that journey today?
I would say it's a tale of two cities, two worlds. So if you look at the open account, which is also referred to as supply chain finance, the actual financing portion of it, which is what the banks see for the 85% of world trade, it is pretty digital. Any bank today can extract a purchase order or invoice data from a customer's ERP system and basically finance a trade transaction on a post-trade basis without having to deal or handle any paper. So that is pretty digital today as far as the trade finance portion is concerned. But the underlying trade between the buyer and the seller, the way they contract and they actually ship the goods, is still paper. For the remaining 15% of the flow, which actually goes through the banks for even the trade to complete, that is pretty much paper. And if you look at what percentage of bills of lading, which is a key title document we are talking about here, is digital versus non-digital, 95% of it is paper, which means 5% is today electronic in nature. Now, one way to look at that, and glass half full, is 5 years ago, that number was 1%. So you could argue there's been a 500% growth in digital bills of lading. But the fact is that only gets us to 5% and 95% is still paper. So I would say we have made progress, but it's been slow.
I guess why is that? I, like yourself, I'm sure, travel to conferences around the world, but we've not actually seen this large-scale transformation yet in digital trade. What's the reason and what, in your view, needs to change?
Key reason, in my view, as it stands today, is interoperability and speaking a common language and allowing not just data, but actual title to move through multiple parties in the chain that is needed to fulfill a trade. Trade is complex operationally, not in terms of concept, but operationally it is quite complex because there are anywhere from 4 to 20 parties in a trade flow. And if you consider oil on the high seas, while the oil is going from export destination to import destination, it could be traded multiple times while the oil is still in transit. So all of that means that there are multiple hands and multiple parties involved in that flow. And for all of that to be fully digital, you need systems that talk to each other, or ideally all of them to be on the same platform or the same system. Now, unfortunately, the way digital trade has evolved, it has been innovation-led in the fintech space. And just to give you a case in point, the number of companies out there that can help shipping companies and carriers digitize their bills of lading, I think is about 13 odd companies today, or probably more than that, but I counted 13. And it's practically impossible for exporters, shippers, banks to join all 13. And they don't talk to each other as it stands today. There's been some initial proofs of concept done, but it doesn't really flow seamlessly between any of these parties today. And that to me is a fundamental challenge. So when blockchain came on the horizon as a technology a few years ago, we thought that, this is a technology that can actually get all of these parties connected. So yes, we went out to over 1,200 corporate leaders from across 17 markets and, various 4 different industry sectors to ask them what's top of mind from a digitization and technology perspective. And indeed, almost 70% came back indicating cloud computing, which is not surprising. So I think we are at a phase where blockchain was tried, tested. People are moving on to newer tech. And AI is definitely at top of mind. But I think the foundational piece for you to get your AI right is to have a good, clean data set within the organization to begin with, and then, of course, connecting externally as well. And that requires you to have systems that really talk to each other. We know in most corporates that have been around for a while and in many banks, there are legacy systems. So getting the data infrastructure and the tech infrastructure right, moving it onto the cloud where it could all talk to each other and you have a data lake that has clean, consistent data is a crucial, I would say, fundamental building block to get the AI use cases right. So if you get that piece right, then of course, then you can leverage that for AI, because the AI is going to be as good as your data is. And if your data is going to be garbage in, garbage out, if the data is not clean. So getting the infrastructure right with cloud computing, because as the requirements go up, as the computing power goes up, if you have it on-prem and not on cloud, it's going to cost you significantly more to hold it. So I understand why the survey that we did and why the leaders are saying what they're saying. So it has to be scalable, and cloud is the way to do it by putting your infrastructure on the cloud that makes it scalable without the same scale in costs, and then deploy AI models on top of that to leverage your business benefits, including trying to digitize the paper, because I think there is cognizance of the fact that the paper will remain around for at least a little while more because of the problems I just stated. So if the paper is coming in, how can we leverage AI models and the latest AI technology like language models and so on to digitize better in a more efficient manner to augment the work that people are doing? Not necessarily to completely automate it on day one, but to augment it with efficiency being driven to deliver results.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
You've already touched on it, but let's drill down into digital assets. Do you see them driving wider trade digitalization? And is it important that we keep talking about them and keep them under discussion?
Good question. And I keep looking at this. I keep an eye on this. So I had an interesting anecdote that I read recently. So if you look at the total USD stablecoin in circulation, it's about 300 billion US dollar equivalent. Almost all of it is supposedly backed by either USD cash or US treasuries. Now, if stablecoin were to be a country, it would be the 10th largest holder of US treasuries, which is an interesting lens to it. It is up to 3 years old. So it has come from nothing to the 10th largest holder of US treasuries. And it is slated to grow with some forecasts, including in our report, Future of Trade report, forecasting it to hit about 2 trillion by 2028. That's going to be a significant number. So is it going to have an impact? Yes. But I would say that the primary impact is going to be first on the payments side of business, because essentially it is a value transfer mechanism, an alternative to fiat currency. The question is why? So it has to be necessarily cheaper, faster, better in order to do so. I think regulations will come in. Right now, there is not, I would say there's uneven regulations in terms of making a payment with the traditional rails, where you need to have purpose of payment, details of the applicant, beneficiary addresses, all of your anti-money laundering checks. which are all not applicable or required today if a digital asset or a stable coin moves from wallet A to wallet B. And I think regulations will come with the US leading with the Genius Act and others will follow. I think that those regulations will come. So it will start with payments. Then it will start, I think, getting into the trade space, first as a settlement leg of the trade itself. So you could still have a letter of credit, but eventually, instead of paying out in fiat US dollars, it could eventual settlement of the letter of credit or a trade finance loan could be in stable coins, for example, or a tokenized deposit, any kind of digital asset for that matter. So that will come. But getting it into the primary flow itself, I think is still a little further away because you still have all these challenges about how do you get all those parties onto one chain. Theoretically, there's discussions about, okay, we can get all the parties onto a smart contract. But I think in my mind, that's a little further away to get all of that done, to get all these parties, including logistical companies, shipping companies, importer-exporter banks onto a single smart contract is still a bit further away. So I think depending on how the payment use cases go, the trade settlement use cases go, distribution of trade assets is another space where we also as a bank have done a pilot under Project Guardian with MAS in Singapore, under the umbrella of MAS in Singapore, where we did an initial token offering or an ITO of $500 million worth of trade assets to private institutional investors, which was taken up. So I think there's definitely legs in terms of trade as an asset class from a distribution perspective to tokenize it, fractionalize it, and get it maybe onto an exchange to get retail investors to buy into it. That's what I would say. Payments followed by maybe custody of it as well, and settlement leg of trade, distribution for trade in terms of risk distribution, and investor classes looking at trade as an asset class with tokenized, holding tokenized digital assets that are backed by real world trade assets. In the actual physical flow itself, it may eventually come, but I think we're still a bit out there in terms of getting to that space.
It's really interesting because I saw that offering and I was wondering why there's not more that's done there. So we're seeing actually more demand here. And I think every week I actually receive an email in terms of real world assets companies and putting actual liquidity into the real world. And I personally can see that increasing. And in terms of what you were saying, where actually there's more regulation coming down the track and the Genius Act, with that idea, it's to all encourage digital assets and digital trade to adoption. But you're right that if we bring this mainstream, you're going to see the similarity towards the standard payment system. If we stay on that regulatory point, where we look at MLETR or the Electronic Trade Documents Act, do they actually help or do they complicate the efforts that we're talking about towards full-scale interoperability and adoption?
Technology tends to lead or front-run regulations. So from a regulatory perspective, a harmonized standard regulation around digital assets and model laws like MLETR being adopted by local regulation is absolutely important. I think that's a given that has to happen, without which things will not move. But it is a necessary but not a sufficient condition, right? So you need to have the legal standards rolled out. You need to have legal acceptability of your digital assets and Electronic Transactions Act embedded in all these markets, both on the buyer and the seller locations. You need customs to be able to accept digital evidences of imports and exports in most markets. But that's a necessary condition. The additional requirement comes back to the interoperability point we made, because how do you evidence all of that? How do you prove that you, Mark, are holding the single digital token that represents this 1 million barrels of oil on this particular ship floating in the high sea? Now, which means that when the token was issued, presumably by that ship captain or authorized employee, it is on a platform. Today, you have to be on the same platform as the bank or the exporter to receive that token. In a public open chain model, that token can move. That's where I think it will come to. So technology has to be there that allows to uniquely, singularly identify that a token can be linked to a cargo in the trade space. That can happen via interoperability with the token passing from platform A to platform B. Or it can happen with blockchain eventually coming back with technologies like stablecoin or tokenized deposits or tokenized EBLs moving on the open chain, which could be interesting. So the question for me is, we are at 5% digital bills of lading. What is the inflection point at which it starts really ramping up? Is that 25%? Is it 30%? I don't know. But there will be an inflection point at which it will take off. And I think that's where we will see a lot of conversion happening from paper to digital.
Sam, tell me, We're talking generally about technology and about interoperability. Actually, what are your clients coming and requesting from you? You're the global head. What are they asking and saying? Are they looking to future-proof their trade? What are they actually focusing on a daily basis? What do your conversations look like behind closed doors corporates around the world?
If you go back a few years, it was all about wanting to learn and understand and maybe experiment. Just do a proof of concept. Let's do a pilot with a blockchain solution, with a EBL solution. And if you look at the latest FOT report, that's exactly what they're saying. It's about the newer technology. So blockchain seems to have taken a little bit of a backseat in terms of actual trade digitalization, but let's get our infrastructure right. Let's get cloud computing and our base infrastructure right, and then look at AI. And AI for me is much wider, much wider than trade, as you would appreciate. It can help you draft your emails, to create your PowerPoint things, to actually do your contract with your counterparty and so on. So it's a general purpose technology. It actually mimics the human brain and ability. I think the top of mind has changed for clients. There is obviously a common theme of finding efficiency and finding value. The pilot POC pieces, I think, for blockchain have kind of gone. That's a bit of the past. Now it's about how do I deploy these new technologies to find either efficiency or value. Cloud computing is top of mind because you get the infrastructure right, then you get your data right, and then that will hopefully help get the AI use cases either within the corporate itself and or dealing with counterparties and banks a lot more efficient.
Really interesting, and I agree. We've talked about interoperability, but actually we've gone from these silos to consolidation. And what you're talking about was blockchain. Actually, the pilots have moved on. What we're seeing is no venture capital. There's not further funding there. It's now real, it's live, and it's in supply chains. So the question now, I guess a bit of blue sky thinking from yourself, but what does digital in the future actually mean? And if we look at from a trade perspective, what's your view going forward?
We will see paper here for a while, at least in the documentary trade space, the business I run. How long that's going to be? When is that inflection point that I was talking about earlier? I think that's difficult to predict, but there will be an inflection point. But let's say it's going to be there for the foreseeable future. Then it comes back to, okay, if the paper is going to still land on my counters and clients are still going to produce paper, or the shipping companies are going to produce paper when goods are loaded on a ship, then what can we do with a technology like AI? And therefore, I think the use cases that most banks and corporates are going to pick up is how do you efficiently convert that paper that's going to come in anyway to data. So that's where I see it heading. So I think AI has a lot more legs, primarily because it is not reliant on the network effect to scale. I could deploy an AI model internally and not be dependent on what's going to happen with my counterparty bank or counterparty client that's going to continue to send me paper. Of course, there'll be that effort to say, let's move away from the paper. 95% of trade is paper because of e-title document, which is the bill of lading. If you look at DCSA and BIMCO, which are the two industry bodies that have carriers or vessels as members, their own views and forecasts are by 2030, most of their members are going to be digital bills of lading enabled. MLETR is being rolled out to most markets. There is going to be an inflection point when you put all of that together. It does require interoperability, and or it does require a solution which will leverage an open chain as opposed to a private permission chain. For these BLs to be in a tokenized form, moving between any party in that chain. It should be as simple as long as I know your address, Mark, I could send you a pouch with the original bills of lading today, anywhere, as long as I know your address. Today, that is not possible with a token unless you're on the same platform with a wallet that I can access or I have the address to in the trade space. Things like stable coins running on open chains like Ethereum, etc., that might change in future. So to answer your question, no crystal ball here, but I think there'll be an inflection point when that starts coming together, where all parties, even if they're not on the same chain, are able to tokenize their key title documents or key documents of value and send it to any other party in the chain, provided there's a wallet address. At some point, when that starts gaining critical mass, you will see a big move to move away from the paper.
Interesting, and hopefully it comes sooner than later. It seems like it's been a long journey. But Sam, thank you so much for joining us today. It was both on point and helpful. I know you've got a busy schedule, so really appreciate you joining us.
Thank you so much. It was a great conversation.